In this video, we are going to talk about how was the real estate market in Toronto and the Greater Toronto Area for the month of February, and how do we expect the market to be in the near future since Bank of Canada has increased the interest rates. That is coming up right now, so stay tuned. Hello, this is Sonia, your local realtor with Remax Realty Specialist. Welcome to my channel where we love talking about real estate and all things in and about Greater Toronto Area, and we would love to take you along the ride. So hit that subscribe button and the little bell icon so you get notified every time there is a new video uploaded. Bank of Canada did exactly what we expected it to do, raise the interest rate by 25 basis points, bringing it to 0.50%. March 2nd announcement was the first move to slow down the red-hot inflation. Before we dig deeper into how will the interest rates affect you or the real estate market in general, let's see how was the market in February. The data showed that sales activity in the Greater Toronto Area housing market fell from record levels in February, but that was not enough to keep home prices from hitting a new all-time high. Toronto area home sales dropped 16.8% in the month compared to last year, with declines across all types of properties. There were 9,097 transactions reported in the month of February. The number of new listings also fell in February, but to a lesser extent than sales. New listings were down by 6.6% from the same time last year, where the sales were down 16.8%. The City of Toronto condo market also saw a rise in new listings in the month of February. Despite the pullback in demand, market conditions remained extremely tight and the housing affordability crisis worsened. Demand for ownership housing remains strong throughout the GTA, and while we are marginally off the record pace seen last year, any buyer looking in this market is not likely to feel it, with competition remaining the norm. The average selling price of a home jumped 27.7% to $1,334,544 in February. Wow, that was a tongue twister. Year over year, marking another all-time high. Average selling prices have posted new records in 5 of the past 6 months. The data comes on the heels of the Bank of Canada raising its benchmark interest rate by 25 basis points. This is the first hike since 2018. Market data from Bloomberg indicates the central bank is expected to hike its key lending rate 5 more times this year. But until borrowing rates rise further, most economists don't foresee there being a meaningful impact on the housing market. Many households sped up their home purchase and entered into a transaction in 2021, which is one reason the number of sales were forecasted to be lower in this year, and a trending towards higher borrowing cost will have a moderating effect on home sales. And now let's talk about how an increase in interest rate will affect you and the real estate market in general. If you want to learn more about how the higher interest rate will affect you in depth, don't forget to watch this video. For those who have locked into fixed mortgages, there is no need to panic as your rates won't change, so you can breathe a little easier. However, rising interest rates will make housing more expensive for those in variable rate mortgages or loans. Now is the time to crunch the numbers to see if locking in makes more sense, especially if a peace of mind is of concern. According to rates.ca, there have been a surge of pre-approval requests to lock in the rates and even an uptick in a 10-year term inquiries. The prospect of multiple rate hikes over the next couple of years has some clients willing to pay a premium for that long-term certainty. When the Bank of Canada's overnight rate changes, chartered banks will adjust their prime rate, which then will impact the variable rates. If the central bank's policy interest rates were to rise, Canadians could feel variable rates for mortgages to increase in lockstep, either instantly or short term. A majority of Canadian homeowners with variable rate mortgage can expect to see an increase in their monthly payments within the month following an interest rate hike by the Bank of Canada. But the remaining portion likely won't see a change in their monthly mortgage payment, but instead of reduction in the amount of principal being paid. While the mortgage payment stays consistent, Canadians in this situation would be paying more in the interest based on increases implemented by Bank of Canada. This could then impact the amount of time it would take to pay off your mortgage. So when the interest rate goes up, you are going to pay a little more interest and relatively less principal. The overall payment is the same, but you are going to extend your amortization period. Those with variable rate mortgages, a rise in interest rate could result in a significant increase in mortgage payment after just 1 year. With fixed rates will generally be higher than variable rates, the extra cost may be worth it to those who would avoid the uncertainty that comes with variable rate mortgages. Interest rates are not going to go down anytime soon. Actually, they are going to go up and up. So the next interest rate announcement is on April 13th, and the chances are the Bank of Canada is going to increase the interest rate once again. Will these higher interest rates be able to cool down the market? The answer is yes and no. Substantial immigration levels and a continued lack of supply remains an issue. However, a hike of 0.25% may not pinch most of the home owners or the buyers, but just imagine the interest rate increasing for next 5-6 times is going to feel like a punch. So be prepared. Crunch your numbers. Do not get emotionally caught into home buying or any major decisions. And if you're thinking of buying or selling real estate in the Greater Toronto Area, I'm just an email or a call away. Thanks for watching, and don't forget to join me next week. Until then, stay happy and stay safe.